Hi, I'm James Blacklaws, and this is a very brief explainer video about an often misunderstood product or service, invoice discounting and factoring. Now, I have bunched them together, even though there are differences between the products, but this is a lot easier for me, and the principles for both of them are the same. Now, the way these kind of facilities work is if you've got outstanding debtors in your business, i.e. people owe you money, and you're struggling with your cash flow, then it helps fill that gap. So while you're waiting for, let's say, £100,000 in outstanding invoices to be paid, you've also got to pay your rent, your bills, the employees, etc., who won't want to wait for that money to come in before receiving their due payments. What invoice discounting or factoring allows you to do is raise a percentage against those invoices. Normally it's around about between 70 and 90% depending on the industry, the quality of the invoices, and you get that money in. You then make the payments for your day-to-day cash flow, your working capital cycle, and then when those payments come in from your clients, the debt is cleared and effectively you go back to square one. Less a small interest charge. So it's a facility which unfortunately has a lot of stigma attached to it. So a lot of accountants don't like it because they see it as expensive. And yes, when you look at it purely against a traditional term loan, it can be seen as quite expensive. And a lot of stigma is linked to the fact that some people see it as a bit of a lender of last resort. So you've exhausted traditional banking facilities, your credit's not so great, so therefore you'll factor to keep the business on life support. Now, in all honesty, 15 years ago, this was kind of the case. Certainly when I started my banking career, there was an argument for that. But now, there's been an awful lot of new influx into the marketplace of lenders who specialise in this kind of niche lending. And it really isn't a lender of last resort anymore. It can be a very effective way to manage your business and actually to grow your business, because the bigger clients you take on, the less favourable the payment terms may be to your business. But you still want to satisfy that client who may offer you 60-day payment terms or even 90-day, but you've got to pay your lads every week or you've got to pay your mortgage every month. Well, this is a way of allowing you to be able to do that at a cost which can then be offset against your business expenses. So it's a tax efficient way of borrowing. So it's very important to really look at these facilities fully and to really understand them fully. If you're accountant or a professional or your mate down the pub turns around to you and says, don't factor, it's expensive, it's not good, well, that's fine, and I understand you respect those opinions, but you need to look at the hard facts. And the hard facts are that sometimes a factored invoice discount facility is the best way to actually finance a business, because it allows the business to grow organically against its own debtor book without a client having to put personal security on the line. Sometimes don't have to put personal guarantees on the line, and it all gets managed within the business cash flow. If the business does lots of turnover, well, your credit limit goes up. If it doesn't, it struggles, you just don't draw the money down, you pay less for your service charge for your interest. It can be very, very powerful and very effective. So never rule out invoice discounting and factoring. It's a wonderful way of using the business's working capital to fund itself. For any more information on that or any other financial products, I'm James Blacklaws. Please get in touch. Thank you.